This week sees the latest FOMC interest rate decision. It's been a long time coming, but it appears to be the case that we're on the cusp of another rate cut from the Fed. Now, what's the outlook in terms of what happens for this meeting, the expectations for the December meeting, the January meeting, and what could be the knock-on implications for US equities, the US dollar, and gold? We'll get into all of that and more in today's video. Kicking off with market expectations, you can see that markets essentially think that this is a done deal. 97% chance currently attributed to a 25 basis point cut. Very little chance of anything aside from that, really. No expectations of an oversized 50 basis point cut, which wasn't that long ago that markets were calling for that. Then you look forward to December, it's a similar kind of picture, 94% chance of another 25 basis point cut from the Fed. Things start to get a little bit more iffy at the beginning of next year. That January figure was 55% all of a week ago. That's now dropped to 47%. So it's no longer the base case scenario that we do see a cut in January. Now, this comes off the back of a period where, of course, we've seen a blackout in terms of data by and large. We have seen the latest CPI numbers, they came in lower than expected, but year-on-year inflation remains elevated at 3%. And so it's a question mark of whether the Federal Reserve are weighing more heavily towards the weakness within the jobs market or towards the inflation side of things. And certainly that's going to be key going forward. If we look in terms of the rest of 2026, you can see that there's a perception that we'll probably get back down to 3 to 325, which means 1, 2, 3, 4, so 2 rate cuts for next year. But in actual fact, the question mark here is perhaps where the neutral rate is, because we need to know exactly where things are going to end, right? The ECB appear to be in that position where they've done all the easing that they need to do. And so markets really want to know exactly where the line is drawn in the sand in terms of how much easing we see within this current phase. Notably, at the second half of next year, we're going to have a new Fed chair appointed by Donald Trump. So there's a strong likeliness he'll come in with a policy of wanting to drive rates lower once again. Nonetheless, for the near term, we're seeing significant downside in terms of rates being priced in. In terms of the outlook for the Fed, of course, they have a dual mandate, which means they need to keep inflation around that 2% target. They need to keep unemployment depressed, essentially. They say full employment, but essentially there is always going to be an element of unemployment. Well, we have seen a gradual rise in terms of both core PC price index and the unemployment rate over in the US. Last week's inflation data, we saw CPI and core CPI both coming in below expectations, but still relatively elevated. 0.3 on the headline CPI number certainly is above where we need to be. And you can see in terms of the sort of annualized metrics, if I look at the 3-month annualized CPI figure, it hasn't necessarily gained ground to the extent that it did in the previous month, but still on the rise. So are we going to break out and ultimately see a surge in terms of price pressures? I'm not sure we're going to, quite frankly. We have, of course, seen some significant numbers recently, but a lot of these tariffs have already been passed through to an extent. So we've seen a bit of a bump. Whether we're suddenly going to see this big sharp rise in terms of price pressures because of the tariffs, it seems unlikely, especially if the 100% tariffs are taken off the table, which of course it appears the US-China issue is softening, as was always quite likely to be the case. Donald Trump already said it wasn't sustainable to enact 100% tariffs on the Chinese, so pretty much undermined his own argument on that point. Now, in terms of the sort of wider perspective around the economy, you have seen here a sort of worsening in terms of, this is highlighted by the Conference Board survey, a worsening in terms of consumer confidence, expectations, the perception of the current situation. So we're seeing a little bit of a worsening around the economy. Of course, the big story has been around the jobs market, and you've seen the payrolls numbers really heading significantly lower, in part down to these major downgrades that we've seen in terms of the ultimate final figure versus the initial figure. So a lot of the time what you see is the payrolls come in, they don't come in particularly strong, markets react to that, and then ultimately a month later, 2 months later, you see a revision. It turns out that initially poor figure was actually awful and sometimes actually in negative territory. So There's question marks around the US jobs market at the moment, and that appears to be taking precedence for the Federal Reserve because they have said in the past they're willing to look through short-term inflation if it's transitory in nature because of the tariffs. Part of the concern has always been, well, we need to know exactly what the tariffs are. If you're threatening 100% tariffs that we're seeing now, but if you're threatening huge tariffs for a number of nations, then we're not in a position to cut rates because we have major uncertainty. So now that he's struck a number of trade deals, there is that certainty, which means that they're able to look through short-term inflation spikes, which we've seen some upside, but it's not necessarily been particularly significant in nature. Of course, there have been concerns that there are many businesses that have stockpiled, and therefore once the stockpiles run out, then they'll have to start importing. That's going to come at a higher price because of the tariffs. You see that getting passed on. So there's question marks around that. But of course, with the fact that the US and the Chinese are in talks, you might actually see a lowering of the tariffs associated with Chinese imports. You're also seeing the Indians potentially coming to the table with a view to cutting out Russian oil imports, and that would drive down their tariff rate from 50% to 15%. So we're actually seeing a potential decline in terms of some tariff rates. The flip side of that is that we've now seen another 10% put on Canada because Trump doesn't like some of the adverts that they're taking out over there. But nonetheless, it does feel like the near-term tariff shock has maybe been passed already, and the inflation boost hasn't really been that significant in nature. So markets are quite confident that we do see rate cuts over the near term. The question mark in terms of this meeting is, do we potentially see the end of QT coming into play, and what's the perception of where we go from here in terms of where's the terminal rate? Where does this all end? Are we likely to see another rate cut in January? Do they take a more sort of cautious tone, a sort of wait and see tone? Are we sort of data dependent? Blah, 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 blah. Those are the kind of things that we're going to be looking out for. Now, in terms of the markets, I would say that probably the most interesting market at the moment is gold. We're seeing a sharp decline for gold at the beginning of the week. That comes off the back of that US-China trade agreement, crucially breaking through the 4,000 mark to take us all the way back down to 39.77, which is the lowest level since a couple of weeks ago. But nonetheless, it's been a really significant pullback. We've seen this massive run up, and ultimately markets don't move in a straight line. And certainly we're in that sort of phase where we're giving back some of those gains. It certainly has been a sort of momentum trade of late. I am bullish for the long term, but certainly question marks over the near term over where this sort of comes to a halt, and especially with the Trump Xi Jinping meeting up ahead, that could spur further downside. Now, generally you see rate cuts as being positive for gold. So if we see a relatively dovish stance coming into play, maybe it holds things up. I do, like I said, see this as a potential sort of retracement phase rather than a complete top for this market. But given how far it's run, there's of course plenty of potential downside to come into play yet. So a break up through your 41.50 kind of area is really the sort of notable thing that would be needed to call an end to this sell-off. For the near term, you're looking at 39.43 as your major swing low support level that needs to break for continuation to play out. But like I said, generally rate cuts good for gold. If we see an end to QT, that could be good for gold, but a lot of it's going to be about sort of relative shifts, and therefore it's a case of like, at the moment, we're pricing a bit less than 50% chance of a rate cut from the Fed in January. Does that become more or less likely after this meeting? That's going to be an interesting one to watch. Then we've got the likes of euro dollar. You can see regaining ground at the moment. You've sort of been on the rally, so weakness in terms of the US dollar. We've pulled back. Are we seeing an end to that bullish trend? Because certainly the US dollar has been coming in for a little bit of buying pressure recently. That is not what I want to get. There we go. Sometimes the fib and the trade targets all look very similar on TradingView. Right, so we've come into a relatively deep retracement. I guess the question mark here is, are we going to sort of bottom out and push higher once again? I think it's quite likely. I mean, ultimately, we're moving into the phase where the ECB this week are likely to reiterate that they're done. The Federal Reserve potentially not. And therefore, you can see here that on the hourly time frame, we are sort of climbing. So I would just keep an eye out on this sort of intraday trend. We've got a 76.4 fib pullback. This is going to be something like a 50%. Let's just put the sort of shallow ones. Yeah, so that's a 50%. Then we've got, again, a sort of, maybe that's a 61.8. There you go, onto the deeps. Yep, 61.8, perfectly. So, we're sort of tagging sort of deep retracement, mid-sized retracement, deep retracement, rallied up into a new swing high. Are we pulling back into another retracement? Good chance that we are, essentially. So essentially, I'm just following this on an intraday basis. I think there is a good chance that we do start to move higher. Do we pull back into the 76.4 over the near term? Remains to be seen. But certainly, like I said, if we see a sort of relatively dovish stance from the Fed, it does provide the basis for further upside for euro dollar. And finally, looking at the Dow, I'm aware of the fact that we have plenty of earnings coming out from the big tech names this week. So I wanted an index that was perhaps less influenced by that, and the Dow would be exactly that. You can see running into trendline resistance, little bit of selling pressure coming in at that point, but certainly for me, very clear bullish trend in play, and therefore near term pullbacks are there to be exploited for the bulls. And so look out for the swing lows. If we break through the 46413 mark, yes, then it starts to look a little bit different. But at the moment, you see your near-term trend, then you see the wider flush out, then you come back into that near-term trend. That's exactly what I think we're doing. We're seeing something similar to this, so I wouldn't expect any pullback to drop below the 46413. So near-term weakness, yes, we could see another retracement from trendline resistance, but I think this is going to be a case of the bulls remaining in charge. But like I said, this week not only has the Federal Reserve, we've also got 5 of the 7 Mag 7 names reporting. So plenty of volatility ahead. I hope that's been useful for you guys. Make sure to like, subscribe and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Thanks a lot.